I'm Dustin Saldarriaga, an immigration lawyer with Scott Legal PC in New York City. In this video, we're continuing our series on the EB-5 immigrant investor visa and taking a look at whether the EB-5 investment can be used to buy shares or assets from a business. For example, you discover that the owner of a local restaurant is looking to sell. Can you use the EB-5 investment to buy the business? Even if you create the required 10 jobs at the restaurant, there are a few pitfalls to be aware of. In this video, we'll highlight what they are and how to navigate them. Before we get started though, please take a moment to subscribe. Through our YouTube channel, we'll keep you updated on our firm's most current and trustworthy information about US immigration, including options to visit, work, or live in the United States. So let's get back to our example. An aspiring EB-5 investor applicant finds a restaurant owner who's looking to sell. What should the applicant keep in mind as he or she navigates the purchase of the business? A key item to keep in mind is that the EB-5 investment must go to the EB-5 business, and the entire amount must be made available to that business so that it can create the required 10 jobs per EB-5 investor and directly employ qualified workers to fill those jobs. When I say the EB-5 investment, I'm referring to the minimum required investment amount of $1,050,000 or $800,000 if the business is located in a high unemployment or rural area called a targeted employment area. This amount must be held by the EB-5 business, which is also called the New Commercial Enterprise or NCE. The NCE must have access to this full amount for the purpose of creating the required 10 jobs. This was at issue in the case called Matter of Izumi, which we'll link to below. Matter of Izumi held that the full amount of the investment must be made available in the business most closely responsible for creating the jobs. The consequence is that the EB-5 applicant's investment must be in the legal entity that's actually creating the jobs, the business that will directly employ the qualifying employees. One of the consequences of the requirement that the investment be available to the job-creating business is that the government will discount from the investment amount any funds that are diverted away from the job-creating purpose. This includes funds that are paid as professional or administrative fees. This is explicitly described in the USCIS policy manual, which explains that the payment of administrative fees, management fees, attorney's fees, finder's fees, and other types of expenses or costs by the EB-5 business that erode the amount of capital made available to the job-creating entity do not count toward the minimum required investment amount. The EB-5 investor must pay these fees and expenses in addition to the minimum required investment. As is emphasized in its policy manual, USCIS will scrutinize any suggestion that the invested funds are not being made available to the business that's actually creating jobs. But what if the EB-5 applicant has directed the invested funds not to administrative or legal fees, but instead toward the purchase of business assets or a share of a separate business? Going back to our example, could an EB-5 applicant count toward the required investment amount the funds that were transferred to the restaurant owner to purchase their business? The USCIS policy manual is again helpful, making it clear that purchasing a share of a business from an existing shareholder without more will not qualify as an investment since the payment goes to the former shareholder rather than to the entity that's actually creating the jobs. In other words, when the applicant is purchasing either company stock or assets, they should be careful to show that the invested funds were committed to the job-creating entity. Then the funds can be used by the job-creating entity for a job-creating purpose, such as purchasing business assets or shares of a business. If the applicant were to transfer funds to the business owner rather than to the job-creating entity, they'd need to ensure that the minimum required investment amount is committed to the job-creating entity in addition to the amount paid to the business owner. One of the questions that often comes up when an EB-5 applicant is looking to purchase business shares or assets is whether any steps are required for the business to be considered a new commercial enterprise, or NCE, which is the name for the EB-5 business that must receive the investment amount. The source of the confusion is that the regulations refer to existing businesses, which can only qualify as NCEs if they take certain steps like reorganizing or restructuring. The key thing to know is that an existing business, as defined in the regulations, means a business that was established before November 29th, 1990. Most any for-profit business that was formed after November 29th, 1990 is an NCE. If you're thinking about purchasing a business that was formed before November 29th, 1990, we have a separate video on steps that such a business can take to qualify as a new commercial enterprise. We'll link to that video below. We hope this video about the EB-5 Immigrant Investor Visa was helpful. If it was, please click the like and subscribe buttons to stay updated on future videos about visa options and travel to the US. Thank you for watching.